I was reading an article the other day and it said something that really stopped me. The old private equity playbook is dead and the new model is emerging. And my very first reaction was like, okay, that's pretty bold. At the same time, I've seen that a lot discussed on X as well. But I was like, okay, I want to go deep. I want to learn this new model because this is vital in order for me personally as well to generate a lot of alpha in the future because the opportunity is there. I kept reading and I realized that if you want to acquire your first business, or if you're already running a business and maybe thinking about buying a few more, or you're a founder, you're an operator thinking about selling, this shift is massive for you as well. And we are talking about the world where cheap debt doesn't bail you out, multiple expansion isn't a strategy anymore, and LPs, lenders, even founders themselves are demanding real value creation, not just spreadsheet tricks. And inside this chaos, as I said, there is so much opportunity and so much alpha to be generated if you understand the new playbook. So this is something I want to cover today because I did a lot of research to put together this new playbook. If you're trying to acquire your first business, if you are already running a company and maybe thinking about buying a new one, or you're just managing a fund already or a search vehicle, or you're a founder, you're an operator, and you're thinking, should I sell to private equity? Should I sell to a holding company or strategic, or just should I maybe just keep compounding? I believe this is a very perfect episode for you. It's very practical. But first, I'm gonna give you a bit of background. The gentleman Lee McCabe, he's a former Meta and Alibaba executive, and he turned into private equity investor. And he said, what made private equity successful over the last 20 years will not make it successful over the next 20. The old model is dead and new one is emerging. Because if that is true, it doesn't just affect those mega funds and Wall Street. It affects the person trying to buy this 3 to 5 million HVAC company. It affects the operator who wants to turn one good business into a small holding company. And it affects the founder, the operator, who's thinking about maybe selling 60 to 70% and rolling equity into the next turn. And what I'm going to break down today is what the old private equity playbook actually was and why it worked so long and so well, why that playbook is failing now, not for a cycle, but structurally. And I want to talk about the special part, the new model, shifting from capital deployment to capability deployment. What this means if you're a founder thinking about selling, and most importantly, what this means if you're a small buyer or a HoldCo builder trying to generate real alpha in the lower middle market, which most of the people listening are. So by the end of this episode, you're going to have such a better overview and a clear strategy, and you can maybe even ask yourself, am I secretly relying on the old PE playbook? Or am I actually building the capabilities that will win in the next 2, 3, 5, and 10 years? The old private equity playbook looks like this. Load up a cheap debt, buy a business at 8x, sell it at 12x. Slap on a board of gray-haired ex-CEOs, add this 90 to 100-day plan, mostly cost-cutting and vague strategic priorities. And then you hope the market bails you out with a multiple expansion. Yes, this model worked super well. It, in some cases, still works, but the tide has gone out, obviously. For a long time, this was the game of the private equity. You find a decent business, you buy it at a mid single digit or high single digit multiple of EBITDA. You finance it with a big chunk of cheap debt, and you do some very basic, let's call it housekeeping. You cut duplicative costs, you plug some obvious leaks, you maybe layer in a small acquisition or 2 or 3. You then hold it for 3, 4, 5 years, which the market re-rates the sector. So now similar companies trade at a higher multiple. You sell, you recap, or if it's large enough, you go public, you do an IPO. And the result, you put in, say, 20 to 30% equity, the bank funds the rest. You sell at a meaningfully higher valuation, and as a result, you make 2.5 to 3x your equity, sometimes more. If you think about it, it's very simple. It's basically house flipping for companies. You put 20% 20% down, bank gives you 80%, you paint the walls, you add the deck, you maybe fix the kitchen, but most of the profit comes from the neighborhood getting hotter, mortgage rates staying low, and people beating up real estate. In the private equity world, the neighborhood was zero interest rates or close to it, a ton of institutional capital flowing into private markets, and public and private market multiples drifting higher across the board. That environment shapes your mental model. And if you come from an age as an investor in that world, it's a natural thing that our job is capital structure and deal flow. Our age is sourcing, negotiating, and structuring. And our age is operating. Yeah, we should do some of that, but the real juice is leverage plus multiple expansion. And again, that's what Lee kept saying many, many times. If you ask 20 B firms what an operating partner does, you'll get 20 different answers. Operating was nice to have. Financial engineering was the must have. And I want to be fair, they didn't make those firms dumb. No, obviously not. It made them perfectly adapted to that specific environment. And the problem is not that the old playbook was irrational. The problem is that the environment has changed. Let's talk briefly about the old playbook. Number one, you bought for 8, you could sell at 12. It's oftentimes not a strategy anymore because the interest rates, they've grown. A lot of buyout models assumed we can borrow at 4 to 5%, we'll service the debt comfortably as EBITDA grows, we'll refinance or exit in a similar rate environment. But then what happened? The rates move up aggressively and suddenly the interest expense on the capital stack jumps. Debt governance ratios compress, lenders get more nervous, and there's simply less room for error. Yes, you can still do leveraged buyouts today, but debt is more expensive, leverage levels are often a bit lower, and lenders want more equity and stronger covenants. The financial leverage lever is weaker than it was back in 2015 or even 2019. Now, the multiple expansion can't be the strategy anymore as well, because from roughly the early 2010s through the COVID boom, both public and private markets were pretty generous. Valuations drifted higher, quality assets in a hot categories got beat up hard, and even boring but predictable businesses traded at premium valuations compared to the prior decade. You could buy at 7 to 8x and exit at 10 to 12x without necessarily being a, let's call it like a wizard operator. Now, in some sectors, multiples have compressed or at least stopped drifting upwards. Markets are more skeptical. Risk-free rates are higher, so all risky assets get benchmarked differently. You might still get multiple expansion if you professionalize the business, you get bigger, and you move into a more attractive buyer universe. But it's not something you can assume as a core driver of returns. And if your investment memo literally says, we'll make our returns by multiple expansion, there's just so much hope there, and it's not good. Another thing, the competition and sophistication have gone up. 20 years ago, fewer funds, less capital, less competition for each deal, fewer true specialists. Today, every niche has specialist funds, searchers, HoldCos. Every founder gets calls from dozens of buyers. The playbooks and the best practices spread super fast. You just can't be a generic mid-market fund or hire 1 or 2 operating partners and hope that some capital structure plus some cost cuts will set you apart. The market is just so competitive. You need to have a real edge. And this is where Lee's line becomes so important. Private equity is shifting from capital deployment to capability deployment. In other words, the firms that win the next 20 years aren't the ones with a lower cost of debt. They're the ones with the strongest, most repeatable value creation capabilities. Which bring us to the new model. But a quick break here. If you're listening to this show and you're already, I can say you're thinking differently about money, about ownership, about building long-term wealth, but you don't always maybe have time or desire to buy an entire company yourself, that's where today's sponsor, CapitalBat, comes in. CapitalPad lets you invest directly into real-world cash-flowing assets, things that generate steady monthly interest. And you can do it without needing to operate anything or hire anyone or take a debt on personally. It's very simple. You're a accredited investor, you invest, your money goes to work, and you earn consistent returns backed by real underlying assets. If you want a place to put capital that actually pays you, go check out capitalpad.com. It only takes a few minutes to learn how it works. I'll put a link in the description as well. Again, capitalpad.com. And now let's go and continue the conversation about the new playbook and the new model. From capital to capability. So again, the old game, raise a fund, deploy capital with leverage, count on multiple expansion. What's the new game? The next wave of outperformance will come from firms that behave more like industrial builders than investment bankers. Let's break that industrial builder's mindset into 4 simple shifts. Number 1, turning from financial leverage into operating leverage. Old mindset will choose returns with the right capital structure. New mindset will choose returns by making the engine more powerful. Practically, that looks like growing top line, improving pricing, fixing sales process and win rates, building real demand generation, tightening unit economics, using data and technology to make better decisions daily. Lee comes from eBay, Expedia, Meta, Alibaba. These are companies that live and die on exactly this mindset. When he looked at private equity-owned businesses in home services, B2B manufacturing, he was shocked by how non-digital most of them were. No proper CRM, no tracking or where leads come from, no structured understanding of the funnel, no tech stack built data in mind. Step 1 in this new model is install a very basic tech and data backbone. That means CRM. I mean like somewhere to capture every leads, every opportunity, every customer. Next is marketing automation. Take emails, SMS, add follow-ups, attribution, call tracking, UTM DAX, like whatever fits you so you know where the lead actually comes from. And then like a funnel view from impression, which is very like generic, you go down to click, to a lead, to opportunity, to revenue, all the way down to the profit. And once this is in place, you get operating leverage. You can actually see which channels are working. You can test new campaigns and know if they are working. You can train sales around real numbers. You can actually spot where leads are leaking out of the funnel. And crucially, you can justify more capital into marketing because you see the return. Operating leverage is literally turning we think this works into we know this works. Here's the data. Let's scale it. Next huge shift is going from theme tourist to a sector specialist. In the old world, we are a generalist buyout firm. We like themes like tech, healthcare, consumer. In the new world, we are obsessive about 1 or 2 specific sandboxes. For example, only vertical SaaS in certain sectors, only home services in a region, only healthcare revenue cycle businesses, only local blue-collar services with recurring demands. Why does it matter? Because specialization gives you pattern recognition. You've seen dozens of P&Ls that look very similar. You know what's good, what's bad in this niche. Reusable playbooks. The same CRM implementation again and again. Same agency or internal team for lead generation. Same sales process improvements. And the credibility with founders. We have done this before in your exact world. You can show real case studies, not just talk about some theory. And Lee contrasts generic PE firms with ones like Vista or Thoma Bravo and with focused investors in home services who only do roofing or only do HVAC. Those are industrial builders. They know the materials, they know the process, they know what can go wrong. And in competitive environment, that's the real edge. Another thing, from founder intuition to institutionalized funnel and data. This is very relevant if you're a HoldCo builder buying from founder owners, founder operators. Most good founders have an intuitive feel for the funnel. They know which customers refer more. They know which zip codes are gold. They know their best salesperson's style. They know which channel seems to work. Could be radio, could be Google, word of mouth. But the intuition is not documented. It's not measured. It's not easily scalable beyond them. But in the new model, you have to map the journey. How does a customer find you step by step? What happens when they call? What are the conversion rates? What's the end-to-end experience? Another thing, you have to build systems around that journey, like CRM, scripts, follow-ups, capacity planning. And all this turns into a data. And now you can answer very quickly, what's your CAC, customer acquisition cost, by channel? What's our average deal size by segment? What's the payback period for marketing? What's our close rate at each stage of the funnel? And Lee has a great line. You don't get the right to win with AI if you don't even have the data. Everyone wants to talk about AI, but if you don't even know where your leads come from, AI is simply a distraction. The industrial builder PE model is data first, systems first, and then you put AI on the top. And as Lee is a marketing guy, I would add step number 4 here as well, like turning this marketing spend into hard revenue accountability. In the old environment, many agencies, they show you vanity metrics. They show you impressions, clicks, likes. When times are good, they claim credit. And when times are bad, they oftentimes blame macro or the algorithm. I've seen this many times with talking to those traditional business owners, and one recent case was that these guys spent like $90,000 on Facebook ads, and sales just kept coming in as they always were, and eventually they just found out that none of those came from those Facebook campaigns. They thought it happened. Some of them must come from there. Actually, it wasn't. So the 90,000 was just they just gave this away and nothing happens. You want to know exactly, not just what's the impressions, clicks and likes, but what exactly is coming, which type of clients are coming from which sources. Because in the new model PE and HoldCo model, the buyer treats marketing as a capital allocation, and the agencies will be an investment. Every dollar of marketing is held to the same standard as any capex or acquisition. What's my expected return? What's the downside? How will I know if it's working? And in practice, that means you demand accountability on customer acquisition costs, ROAS, and payback period. You're not happy with just impressions. You expect your agency or internal team to speak of revenue, not just the clicks. You build dashboards where you can literally see, we spent X here, we got Y customers worth C in revenue. And once those unit economics look good, as Lee says, your marketing budget should be bottomless. If you target customer acquisition cost, for example, $200, and the channel is consistently landing customers at $200 with a very strong lifetime value of the customer, why would you cap your spend? Why don't you just spend more? And the answer is very usually like because you don't have enough capacity, or because your funnel isn't instrumented well enough to trust the numbers. The capability deployment model solves both. It builds the capacity and it gives you the data. Now I want to talk about this new model, and if you're a founder, so how to think about selling your business in the new world. If you're talking about investors, buyers, and if they're listening, and say you run a home services business, you run maybe a manufacturing company, a niche B2B services firm, a small software or a tech-enabled business. You've built this thing for the past maybe 2, 5, 10, maybe 20 years, and now you, over the past few years, have been getting emails, calls, LinkedIn messages from PE firms, family offices, searchers. People who are listening to this episode know that they have to reach out, like all sorts of different messages. So how should you think about this when we compare the old model and the new model and having this shift? Very important thing. You have to diligence the buyer as hard as they diligence you. And many founders don't do that. They get an offer, a headline number, maybe 1 or 2 reference calls, and then they are willing to sign maybe 3 to 5 year partnership with people they don't even know. But in the new world, let's do it differently. Questions you should ask. What have you actually done with companies like mine? I mean, like, these are the questions the seller should ask from the buyer. What have you actually done with companies like mine? Show me real examples where You helped grow revenue, not just costs. What does working together look like after closing? Weekly calls, monthly? Are you involved or hands off? And can I speak with founders you've backed? Ideally, one where things didn't go perfectly and hear how you behaved. And one more, how exactly do you plan to create value in my business and be extremely specific? And if the buyer can't answer those questions clearly, they're likely still in the old playbook. So let's say, okay, you talk to those founders, but you still found yourself in a position where, no, I don't want to sell my business, but I want to have this new playbook proof for the future. So if I can sell in the future, it has this higher valuation because everything is in place. So a few practical moves. Get your funnel out of your head and put this on the paper, as we covered. Where do customers actually come from? What's the rough conversion rate from inquiry to sale? What are your best sources of business? Another thing, implement a simple CRM. Doesn't have to be perfect, just functional. Start tracking leads, deals, customers. Make sure you track marketing spend and results. Even in a spreadsheet, we spent X on radio, Y on Google, Z on mailers. Here's what we think it produced. Next, build a basic digital presence. Have a website, have some good Google reviews, simply ask from your customers. There are many people who are very happy about your product and services, and kindly ask them to write a Google review. And just make sure that customers can find you online. And make sure you document key processes like have a sales scripts, onboarding, service checklist. Again, the goal it is not to become like a Silicon Valley startup. The goal is to become a legible, scalable asset that the capable buyer can plug into their system and grow. And ideally, that they can do it fast. Because that is exactly what the new model private equity or a holding company or a simple smart ETA buyer is actually looking for. And if they find a company like this versus an old look company which doesn't have those things, your company is going to be so much more valuable for the new buyer and they're willing to pay a lot more. And now my favorite part, the favorite group, HoldCo builders, ETA buyers, small funds. Here's the opportunity in one sentence. The lower middle market is still full of people behaving as the old playbook works, and you can generate a lot of alpha by quietly playing the new game. Many deals from 5 to 20 million enterprise value still look like they have like bad sims, weak data, no real digital presence, buyers underwriting on leverage, vibes, hope. And you're not going to beat KKR or Blackstone on cost of capital, balance sheet, size of the fund, but you can absolutely beat them on speed on learning in a specific niche, operational capability, digital and demand gen execution, and lastly, and the most important, founder relationships. There has been so many guests on HoldCo Builders podcast where they bought the business on an extremely attractive price only because they were able to build a relationship with the buyer. Again, this is something that the guys from the KKR, the Blackstone, they can't do that. They won't do that. That's how you can find those extremely good deals. So what is the best way to think about this? You have to pick a sandbox and stay in it and commit. That could be home services in one region, accounting firms in a certain size band, niche industrial B2B, micro SaaS with specific traits. The point is very simple. Specialization multiplies your learning and your edge. You see more deals that look very same. You learn what's good, what's bad very fast. You can reuse playbooks, you can reuse tech stacks, you can build relationships with vendors and operators that fit that one sandbox because you understand this. And when you talk to the founders, you can say, we're not tourists, we live here. We've done 1, 2, 3 companies just like yours. And that's a completely different conversation than we are a generalist fund and we like your EBITDA. Even though a lot of people can talk the talk, but eventually if the seller will ask some specific question, they will very quickly find out that you still are a generalist. You want to become this extreme specialist in one specific niche and vertical. Let's bring this home. We started with a claim, the old private equity playbook is dead and the new model is emerging, because the truth is there is so much opportunity and so much alpha to be generated for the people who treat this like industrial building with capital, not gambling with spreadsheets. So I hope you learned a lot. I tried to make this as practical as possible. if you are still listening, please subscribe if you haven't already, and send it to one friend who you know are maybe going to buy a business, or they're running a PE-backed business, or they're maybe thinking of selling their company, because I hope they learned a few things. They could learn a few things from here. And that's it. My name is Mick. This is HoldCo Builders. Thanks for listening, and keep building.